the head of product development and strategy at ICICI Prudential AMC. Chintan has been with ICICI Pru AMC since 2005, and he has managed multiple funds such as the equity arbitrage fund of ICICI Prudential, the long-term equity fund, equity savings fund, the children care gift fund. So a lot of experience in terms of portfolio management and research. He's also known for market intelligence. He has managed and developed products strategy across products such as mutual funds, AIF, PMS, indexing, and ETFs. Mr. Haria will today show us what are ETFs, what an important role they play in our portfolio, the growth of ETFs, and how you can do asset allocation through ETFs as well. In the second half of this session, I will take you all through IIFL's ETFy platform, which is a dedicated platform for ETFs. There are beautiful themed baskets available for you to invest into ETFs. It makes the journey absolutely simple. So I will take you all through that in the second half. Please feel free to post your questions in the Q&A section. We'll try and take as many questions as time permits. With that, I would again welcome Chintan, and over to you.
Thanks a lot, Hedley, and thank you everyone for taking time out on the Friday evening. ETFs, as we all know, are globally as well as in India a preferred choice as far as investments are concerned. I have a few slides which I'll showcase soon. But before we move on to the slides, I just thought I'll give a brief background. If we see since 2008 in the United States, the trend towards increasing ETFs has been seen and it's quite stark, because today as we speak, the ETF AUM in US is $9 trillion, while the non-ETF AUM is smaller than that. And this is for the first time in the 250-year-old history of United States mutual fund that the passive funds or the ETFs have outpaced the active funds. We are seeing that trend grow in India as well. ETF AUM in India used to be very low. Now we've crossed more than 4 lakh crores in AUM, I think, in India as well. And there is also a strong support, apart from the provident funds which were allowed in 2015-16. There is a strong, let's say, inflows happening from retail HNI, who are also realizing the importance of ETF in their overall allocation. So as Hedley mentioned, that when you have an overall asset allocation plan, you will have everything within it, right? You will have fixed deposits, you'll have insurance, you'll have mutual fund equity funds which are actively managed. And now people are adding on to that in terms of passive funds, such as index funds and ETFs. Exchange traded funds, what are they, etc. Now I'll switch on the presentation and show it to all of you for making it easy. But we have no doubt that ETFs play a very important role in your asset allocation requirements, and they are very easy to execute on the exchange, much like you execute a buying and selling of shares. So I'll show the presentation, take you through that, and hopefully many of the concepts which are related to ETFs will get clarified as we move along. So let's look at the basics of ETF. What is an exchange traded fund? An exchange traded fund is essentially nothing but a mutual fund which is listed on the exchange for you to be able to buy and sell via your trading account and the demat account. So it's as good as buying a share. The advantage is that the ETF, let's say for example it is the Nifty ETF or the Sensex ETF, it will have all the 50 stocks of the Nifty which are in the underlying stock. So you can buy on the exchange one single unit, which would be about 100 rupees or 150 rupees as the case may be. And in that 100 rupees or 150 rupees, you'll get the exposure equivalent to getting the exposure of the entire Nifty 50 stocks in the same proportion. So ETFs makes it easy for all kinds of investors to participate in the equity markets, even with lesser quantum or lesser unit size. They follow basically the index. They track an index. So all ETFs will track an index. There are no active fund managers who are buying and selling the securities. They track an index. When you say track an index, like I said, there is Nifty 50 or Sensex or mid cap. As the case may be, each ETF, based on the name, you'll be able to figure out what is the underlying index. and all the constituents of that underlying index in the same proportion that they are represented in the index are bought by the ETF on your behalf. So the fund management or the dealing team ensures that the ETF is mimicking the index. Generally, the ETFs, because there is no fund management involved, have a very low expense ratio. Typically, if you see, let's say the Nifty ETF or the Sensex ETF, they are less than 10 basis points. So if you look at from an expense ratio perspective, you will have generally ETFs at a very low expense ratio. That is also what is making them very attractive for investors to participate in their equity allocation journey. The next is essentially, if you see ETFs, they are traded on the exchange. So suppose markets were down about 2% or 3% today on the mid-cap space, and you want to take advantage of that falling market. So instead of waiting for the day end, so typically in a mutual fund, if you put your money, you get the day end NAV. But in an ETF, because it is traded on real-time prices, if there is a fall in the market, you want to take advantage of that. Anytime during the day, based on the real-time prices, you are able to execute the order. So that is also something which is a very unique aspect about ETFs, which is helpful. ETFs in general in India are in the equity category, but now we are seeing debt ETFs and commodity ETFs like gold ETFs, and now hopefully soon silver ETFs also coming up. But predominantly right now it is in the equity space that there are ETFs, and very transparent every month. In fact, every day via the portfolio deposit, you can see what are the constituents of the ETF. So on a daily basis, practically you get to see what are the constituents of the ETF. The methodology for each ETF and each index on which the ETF is based is available on the websites. So the methodology is also very clear and it does not change. So you know exactly where your money is going. So there is a lot of transparency. It is cheap. It is very efficient. And from your perspective, it fits your investment requirements in general across the various products that are available in ETFs. And I'll come to the various products. As I was mentioning a little while earlier, look at the growth of ETFs globally. So we've seen generally, right, in whatever happens in the world, it probably happens in India with a lag, but it does happen. So if the telecom revolution happened in the world and everyone was using cell phones, in India, we basically saw cell phone adoption also happening, and now most of us have a cellular phone or a mobile phone, as it is called. Similarly, digital technology or over the top, like generally we used to watch television, via cable TV. Now most of us have moved to the digital medium, wherein through the OTT apps, we are actually watching so that kind of adoption will also be seen in the financial world. If you see the global ETF market, it has grown exponentially since 2008-9, as can be seen. What was less than $1 trillion about 15 years back is more than $9 trillion today. And that essentially is showcasing the growth of ETFs globally, and it is significant. In India, if we see, this is also reflected. Our AUM in ETFs was less than probably 10,000 or 15,000 crores back in 2010. Today, that is touching or has crossed 4 lakh crores. So clearly the snowballing effect of education, understanding importance of having low cost, transparent, ease of investing vehicle like ETF in your overall portfolio, that all has helped investors. And I think if we see millions of new investors are starting to invest in ETFs, as can be seen from the data. So effectively, ETFs is the way to go. Now, what are the kind of ETFs which are available? While this is a snapshot of the ICICI product suite, and eventually as a provider, as an ETF provider, we want to be the one-stop shop for you to have all the potential investment solutions within the ETF space that you should have. There are 3 broad categories within equity where the ETFs are available. So market cap based category, which is essentially that category wherein based on the size of the company, the selection of stocks happens. So Nifty 50 ETF or Nifty ETF as it's called, it typically picks the top 50 names by market cap. Then there is Sensex. It is typically the top 30 names. There are certain filters, etc., but generally it is the top 30 names. The next 50, the Nifty next 50 is the 51st by market cap to 100th by market cap. Market capitalization is the size of the company. Nifty 100 is the top 100 companies. Mid-cap 150 is the 101 to 250th company. So if you want to participate in the mid-cap segment in India, which is basically blue chip segment is the top 100 companies as it's called. Mid cap is 101 to 250. You want to participate in all the 150 companies which are considered in the mid cap space, then you can simply invest in the mid cap 150 ETF and get the advantage of all the mid cap companies which are there in proportion that they represent in the index. Then there's a mid cap select ETF. So this does not have all the 150 names. It has the 30 names which are select names, larger names within the mid cap space. And the most important from a long-term allocation perspective, if you want to allocate money for the long term, then the BSE 500 ETF. So the ICICI Prudential S&P BSE 500 ETF, it has all the 500 securities which are listed on the stock exchange, the top 500 names. And if you start participating in it and keep buying it over the long term, you may end up having basically created a portfolio which will probably on a risk-adjusted basis beat more than 50 to 60% of whatever other investment vehicles are available. So BSE 500 is a classic tool in your hand to participate in the entire market virtually in a very easy manner. Then there are sector or thematic funds within the ETF space. We have India is a blessed country where not just we have diversity in terms of geography, in terms of people, in terms of language, we have diversity in terms of sectors which are in business as well. There are many countries like, for example, Indonesia, Australia, they're dependent on one large sector or one large mining sector or one large banking sector. India is blessed with a very diversified set of sectors in which there are large companies. So the banking sector in India is large. Within the banking sector, if you see, there are private and public banks. So you have the Bank Etf, which has the largest banks in India, including the public sector bank. And then we have a very nice niche idea, which is the private bank ETF, where only the private sector banks are available. The top 12 or 13 private sector banks are part of the private banking ETF. Then you have the information technology. We all know technology companies have done well in the last 3-4 years. So you have the ICICI Prudential IT ETF, which has has the largest 12 to 15 names within the information technology. If you have the Healthcare ETF, again, India is the biggest outsourcer of pharmaceuticals. And we've seen through the pandemic that be it vaccines which need to be produced on a global scale or medication, India is at the forefront, and hence Indian healthcare companies are at the forefront. And you have the Healthcare ETF, which captures the largest Indian companies in the healthcare segment. So you don't have to pick and choose an individual stock within the healthcare segment. The entire healthcare segment, the main companies will be available in the Healthcare ETF. Then you have the Fmcg Etf, which is essentially the fast-moving consumer goods, as they are called. So typical day-to-day need items like soaps, detergents, toothpaste, etc., noodles, tea, coffee, all of that, the larger companies within that space are available in the Fmcg ETF. We are right now in the process of the new fund offer of the consumption ETF, where you have the sectors like auto or consumer goods predominantly, which are representative of the consumption growth in India. So this is a beautiful ETF, the ICICI Prudential Consumption ETF, whose NFO is going on right now. This is a beautiful ETF for you to participate in India's consumer growth story. And as we move along, of course, the different sectors and themes which are being missed out right now, hopefully they'll become part of our bouquet as well. So if you have any ideas on sectors and themes which you would want to invest as an ETF, please do bounce it off to us and we'll try and create a portfolio out of it. The next is on factor-based ETF. So clearly globally as well as in India, the factor-based ETF, or the smart beta as it's called, where the selection of securities is basis a particular factor. It could be a fundamental factor, it could be a technical factor. Fundamental factors include price to earnings, price to book, return on capital employed, return on equity, profit margins, sales growth, etc. And technical factors include volatility of price, returns in the past 6 months, 12 months, etc. So you have technical factors and you have fundamental factors based on which you can create a portfolio. And not just selection of stocks, but also the weightage of stocks can be determined on the basis of this factor or a combination of factors. So in that bucket, we have 3 funds currently: the NV20, the low vol 30, and the alpha low vol 30. So We were first to launch India's smart beta ETF on low volatility, which is the which is the low vol 30. And it is a beautiful product which allows investors to participate in the 30 most stable companies among the top 100 names. So the stable part is essentially the low vol. Low volatility is a statistical measure. And based on that low vol statistical measure in the last 1 year, the selection of 30 stocks happens, and the stocks are also weighted. The weightages of the stocks are also on the basis of the factor of low volatility. So this is a unique product which is gaining ground among investors, and investors are liking it a lot because it gives a lot of stability. It being a large cap oriented product, it will also the universe is also stable, and within that, if you're picking up stable companies, generally the trend has been good from a risk reward return perspective in this particular ETF, which is the low vol 30 ETF. The Alpha Low Vol 30 is India's first multi-factor ETF, which we launched at ICICI Prudential, wherein we are taking two factors. One is alpha. Alpha is nothing but returns. So the companies which have delivered best returns and the companies which are stable. These two factors, you rank the top 150 names, and then you add up the scores. You get a good fit of stocks which have done well but have been stable. So you have the blend of both stocks which have done well, that is speed with safety. And if you add back the speed with safety in terms of low volatility, you get the Alpha Low Vol 30 ETF. The NV20, which is also a factor-based ETF, it's a very simple ETF. Out of the Nifty 50 companies, 20 stocks are picked up, as the name suggests, Nifty value 20. So you pick up 20 stocks which have been curated on the basis of four factors: price to earnings, price to book, dividend yield, and return on capital employed. All these four factors are put together. The scores are put in the Nifty 50 stocks, and the top 20 names on the scores of these four factors are picked up for the NV20. So in the factor-based or the smart beta space also, we see probably a few more additions which will happen. And we believe that these will add a lot of value, especially low vol and alpha low vol are superb fits for investors who are looking at alternates to basically the large cap space, who are looking at alternate investing. This becomes a beautiful handy tool in terms of the low vol 30 and the alpha low vol 30. Then you have the debt ETFs. That trend is also increasing. Within that, you have the liquid ETF. Many of you would be trading in futures and options, or want to park your money temporarily while you have booked profits and then ultimately redeployed in the markets. That's where the ICICI Prudential Liquid ETF can be very handy. You basically, if you sell in the market, immediately you can go and buy the liquid ETF so that you don't lose out on the yield, etc. And then whenever you want to use that money for investing again, you can sell the liquid ETF on the exchange and buy the securities. As well as this liquid ETF can be used as derivative margins for those who do F&O trading. Among the commodity ETFs, gold is a very popular commodity, and I would like to spend 5 to 7 minutes on gold itself. We've seen equity markets do well on the back of central bank liquidity globally, and equity markets globally have done very well. Real estate markets have started to do well in India. Globally, they're already doing well. Interest rates are in general very low. In such a scenario wherein low interest rates, easy liquidity has caused commodity prices to go up, equity markets to go up, it is but natural that inflation will go up. And when inflation generally goes up, gold becomes a classic asset class to hedge yourself against an inflationary spiral. So last 1 year, maybe last 5-6 years, or even 10 years, if I have to see, gold has been a relative underperformer, and gold investing has not been a very large aspect of investors' portfolio. We believe that through the ICICI Prudential Gold ETF, you should be curating a portfolio of 5 to 10% of your overall financial assets into the gold ETF, because ultimately when there is volatility in the financial markets, or if there is inflation which comes back because of the easy liquidity, gold will probably do better than at least debt. And even if equity markets fall, initially gold may have a corrective phase, but eventually it bounces back. So our past experience has suggested that given where valuations in equity are, given where valuations in debt are in terms of low interest rates, having a certain portion of your money in gold ETF will help you hedge against volatility in the financial markets, against inflation which may come in because of easy monetary policy, and also if rupee depreciates, anyways, you get the advantage of that getting reflected in the gold prices. So that's where we stand in terms of the gold. We firmly believe that 5 to 10% of your portfolio, incrementally, whatever money you have, if you already have equity and debt and you want to participate, I think the ICICI Prudential Gold ETF is a very interesting tool in your hand. I think I've covered basics of the investing which I needed to cover. I'll hand it over to Headley for his comments, and then we can open it up for Q&A. Thank you. Headley, over to you.
Thank you, Chintan. Thank you for the very detailed brief you have given us in terms of the diverse universe of ETFs. Thank you so much for that. I will now move into the second section of this webinar. I will take you all through IIFL's dedicated platform for ETFs. I'll just share my screen. So this is IIFL's, you can see my screen?
Yes.
So this is IIFL's platform for ETFs. We have created this platform so that you can straight away, customers usually ask us two questions, which ETFs to buy and how to buy. This platform really answers that question to the greatest detail. What we have done here is we have created portfolios based on various themes. So you do not have to go and search for which ETFs to buy. This platform straight away, pulls out or offers you the best ETFs available suited for a particular theme. We have created 5 baskets on this platform. So India consumer, we've got sustainable India. We've also got smart portfolio, emerging opportunity, and India's top 250. So take, for example, India's top 250. This gives access to the largest 250 companies in India as per market cap. This portfolio gives you a good blend of large cap and mid cap. It's extremely diversified. Just by investing 1,500 as per today's price of ETFs, you can get exposure to the top 250 companies. So we've seen a lot of retail investors having a lot of stocks in their portfolio, but that is not required. If you simply go ahead and buy an ETF, it really adds up to the same thing, and you can make much better returns on a more consistent basis. So there's 1,500 rupees, you can make a lump sum investment, or you can also start an SIP in the India's top 250 basket. And this will give you returns at par with the indices. Same case if you want to go in for consumer, you want to invest into companies which are focused on the consumer. We have created the India consumer basket. This basket offers you ETFs across the consumption pie. So the Nippon India consumption ETF, it is largely domestic focused. The ICICI Pru Healthcare ETF, you get good exposure to the pharma companies of India. And then the Mirai FANG, which gives you access to global companies such as Facebook, Amazon, Google, Netflix, etc. So a very diverse mix is what you get by paying just 435 rupees. Just it's an investment of less than 500 rupees, but you get access to excellent theme like India consumer. If you want to invest, say, into the smart portfolio, the smart beta ETFs, which Chintanji was just referring to, you can go in for the smart portfolio ETF basket, and you get access to ICICI Pru's Alpha Low Wall, the gold ETFs, which we think are expecting to do very well in terms of asset allocation, and then the Kotak NV 2050. So basically, all you have to do is choose a basket as per the theme which you prefer. select a basket, just click on this invest now, and you can begin your investing journey. If you want to know why ETFs make a lot of sense, so essentially ETFs are tax efficient in terms of these ETFs rebalance their portfolios as per the index. So every 6 months or every quarterly, as per the index rebalances its portfolio, the underlying portfolio gets rebalanced. However, only when you sell an ETF, that's when capital gains is applicable to you. And hence, it's a very tax efficient way of rebalancing a portfolio, getting the benefit of rebalancing, but it's very tax efficient in the other sense, given that you don't have to sell the ETF. You just hold on to ETF and the underlying keeps getting rebalanced, and you get the benefit of rebalancing the portfolio. In the same case, ETFs, there is no lock-in at all. So you can you purchase any of these baskets, the ETFs gets transferred to your demat account, and then you can sell it as and when you would like to. These baskets start at less than 500, as I showed you, and ETFs, like even how Chintanji referred to, the cost of managing an ETF is extremely low, hence the expense ratios for an ETF. So basically, if you go for a large cap ETF, the expense ratio is barely 7 to 8 basis points. Hence, extremely cost effective on the expense ratio side as well. So I would suggest everyone to visit the microsite we have created, etfy.indiainfoline.com, and have a look at these baskets. This is available only for IIFL clients at this point in time. So we will open it up to others as well soon. In case you want to have further details about ETFs, you want to know more about ETFs, you want to read through, we have a microsite, indiainfoline.com/ETFy. You can visit this microsite and read about ETFs. It's a very comprehensive site and gives you good advantages of ETFs, why ETFs, different types of ETFs, and it gives you a comparison between ETFs and mutual funds as well. Please do visit the site, and if any queries, we will be conducting similar sessions going forward as well. So you can please, share it in the Q&A and we'll take them up. With that, we will move to the third section of our webinar. So our first question is, what about Silver ETF latest launch? So could you share your thoughts on that, Chintanji?
Yeah. So Headley, what has happened is the regulator has come out with a paper that silver ETFs will be allowed, but we are waiting for the final regulations in terms of how, what, and where. Once that is announced, we will approach the regulator with the filings and launch the silver ETF. Our guess is that it will be similar to the gold ETF, and hopefully soon investors will be getting a chance to invest in silver also through the ETF route.
So how much percentage of one's portfolio should be invested into ETFs?
So if I look at the overall portfolio construction mix today, based on where the market is, or even in general, we firmly believe that 40 to 50% of your portfolio should be in the core dynamic asset allocation basket, which is the balance advantage fund category. Once you have put that 40 to 50% in the balance advantage fund category, the remaining 50% you can potentially divide it based on your risk profile in terms of Fmcg fund, value-oriented funds, maybe about 20% there. And the next 20% you can allocate through ETFs. It could be through large cap ETFs, multi-factor ETFs, smart beta ETFs, and then 10% to gold. So I would say 50% in the dynamic asset allocation basket, 20% in Fmcg funds or value-oriented funds or special situations funds or business cycle funds. So that's the 20% depending on what you like as an investor. The next 20% should be in ETFs. You can divide it between 2 or 3 or 4 ETFs as the case may be, or you can have it in one ETF also, like a BSE 500 ETF, for example. and the next 10% should be in gold ETF. So if you have this kind of a portfolio, you are getting enough diversification. The dynamic asset allocation funds provide you with the support that is required if markets become volatile. Gold will also help you there. The in between 40%, which is in pure equity via the ETFs and the active funds, will provide you with the uptick and the wealth creation through the ETF. So I think this is a very healthy mix of portfolios. And as an investor, if you stick to discipline, the important aspect is that sticking to discipline. When markets are high like they are today, if you invest 100% in equity, and then when markets fall like March 2020, we saw a very sharp fall because of COVID, and you take out money, it becomes very difficult for you to generate long-term returns in equity or create wealth. The key to wealth creation is that you buy low, sell high. You buy when the markets are weak or valuations are cheap, and you probably reduce your equity when the valuations are expensive. And that can be easily done with this portfolio approach or allocation approach, which you can set for yourself. And most important is follow that with discipline and have patience. Discipline and patience are the two key emotions which will help you to generate wealth in the long run in equities. Thank you.
So, in terms of equity, mutual funds offer higher returns than ETFs. So, your thoughts on that?
So, there will be times when ETFs do well. There will be times when equity mutual funds will do well. India being a growth country, there is no doubt that if the fund manager can pick up the right sectors and stocks, there is a chance of creating alpha. We've seen that happening in the ICICI Prudential India Opportunities Fund or the ICICI Prudential Infrastructure Fund also, wherein special situations investing has helped create alpha. So there will be opportunities which are there and which can be exploited by the fund manager on the active side. On the ETF, what happens is you get the advantage of the market pickup. So if you look at 2018, 19, 20, it was essentially Nifty which was doing well, and the active fund managers or the diversified funds weren't doing well. Hence, if you have an approach wherein you have best of both worlds, or if you have a combination of active and passive, you have a combination of ETFs and active funds, you will probably be better off, because honestly, none of us can predict when will one do well, when would not do well. But if you have a combination, you'll be participating in both. And so while ETFs are mimicking an index, they'll give you index returns. Sometimes index returns are better than that of the active funds, and sometimes active funds do better. Last 1 year, if you see, most active funds would be able to beat the benchmark because the market breadth has improved. Similarly, when the market breadth narrowed in 2018-19, wherein only 10-15 names in Nifty did well while rest of the market was actually capitulating, it was only the Nifty which did well. So if you have a combination of these two, it basically helps you without worrying too much about what will do well. You're participating in both, and your portfolio health in terms of risk, return, reward will be good.
Right. So next question is, what are liquid ETFs? If you can elaborate on that.
So Liquid ETF as a product is essentially used for those investors who want to park their money, right? So many investors park their money in liquid funds, saving funds on the mutual fund side. So these investors can also park it on the liquid ETF that is there. Very easy to do that. You just go online and park it. The key uses of the liquid ETF. So if you go and basically, if you have money in your bank account, you go and buy the ICICI Prudential Liquid ETF. The key uses generally that we've seen investors is, one, if you have derivative positions, against the derivative positions, you need to keep margin with the exchange. So instead of keeping cash margin with the exchange, you can have the liquid ETF units, which can be given to the exchange as margin. The broker can use it as a margin for your derivative requirements. And second is that whenever you, let's say, sell securities or sell your equities on the exchange, you can immediately buy the liquid ETF so that you don't have to, the money doesn't come into your bank and it doesn't have to go back. And then immediately, suppose 3 days later, you want to buy on the exchange, you sell the liquidity ETF on the exchange and you can use that money immediately to buy on the exchange in terms of whatever securities you want to buy, whatever equities or whatever other ETFs that you need to buy. So it is essentially a beautiful liquidity management tool available for the investors. You just have to go and park it in terms of the money. The NAV, which normally it quotes at, is 1,000 rupees. So that stays steady, and every day you basically keep getting dividends, and that is credited in the bank account in terms of cash for the investor. So the utilize or the use case of ETFs is liquid ETF is very simple, either for your margin requirements or for parking it so that you can use it whenever you want from a exchange perspective. These two are the primary uses, and it is very popular among those investors, especially who are using other means for derivative margin.
Right. So the next question is, I'll take this. Is there any lock-in for ETFs? I mean, there is no lock-in. You can buy it and sell it anytime, I guess. So there's no lock-in as such for ETFs. Are ETFs suitable for young people? So for someone at the age of 30, would ETFs or would ETFs be a part of the portfolio?
Yeah, in fact, ETFs should be the first starting point for most investors, right? Because young investors, let's say you are getting your pocket money or you are saving your first, let's say, salary, money out of your salary, you don't necessarily know which mutual fund to invest, how to invest, etc. You can start with a small corpus in gold ETF. You can start with a small corpus, let's say 1 unit, 2 units, or 5 units of gold ETF, 1 unit, 2 units, 5 units of Nifty ETF or Sensex ETF, as the case may be. So once you start small and then it accumulates over time, you will see the advantage of the power of compounding that happens as you keep buying small. So instead of you having to block 5,000 rupees or 1,000 rupees in one go in, let's say, a mutual fund, there also obviously the unit sizes are coming down. But here, as and when you have savings, you can take basically 100 rupees, 200 rupees, 500 rupees. You can keep putting. There's no limit, of course. You can put as high amount as you want. But for a new investor, I would say that start investing. First step is start investing in equity. You can do it through the active route via the systematic investment plan. You can do it through the systematic investment plan in ETFs as well, wherein on a weekly or a monthly basis, you can keep buying on the exchange in terms of the units. An important aspect is that asset allocation discipline. So you start investing, and over a period of time, as you know more, as you will probably understand more, you will be able to create a more diversified, balanced portfolio. But the idea is start investing, and the categories in which you should start is the large cap universe, which is Nifty, Nifty 50, Sensex, or even the BSE 500, which is the all 500 names, or gold ETF. So these are the ones. And of course, those baskets which have been created, in fact, by IIFL are something which are very unique. And you can actually start with that basket itself. I saw many baskets for 400 rupees or 600 rupees, as the case may be. So you can start with those baskets also. They've been curated beautifully by IIFL, and you'll get the advantage of getting 2 or 3 ETFs at one go and creating a portfolio with 400, 500 rupees over the long term, which will accumulate and generate returns for you. Equity markets have their risk. So don't think that equity markets only keep going up. If you see the last 3 days, equity markets have corrected as well. So in the long run, equity markets have a trajectory which is upwards, but in the short run, they'll be volatile. So it is very important to systematically, with patience and with discipline. Again, I use the 2 words, patience and discipline, to participate and keep participating even in the downturn. So equity markets are the only place where if there is a discount, if the markets are cheap and if markets are falling, people run away rather than trying to buy. Anywhere else there is a discount, you will go and buy, right? Cheaper books, cheaper clothes, cheaper electronic items, because of discount sale, we go and buy. But in investments, when the fall happens, somehow we end up fearing the fall and we do not invest. So that's something which you should keep in mind, that whenever there's a fall, you invest more. Currently start accumulating via SIP. And for newcomers, I would say that clearly gold plus Nifty plus Sensex plus BSE 500 plus low wall, or the baskets which have been created by IIFL itself, are a beautiful way to start investing. Thank you.
Thank you so much, sir. So with that, we come to an end to Q&A. That was the last question we had. So just to conclude this webinar, I believe everyone should visit the ETFy platform for greater experience in terms of purchasing ETFs. Make ETFs a part of your portfolio, because ETFs, the AUM on ETFs is going up significantly, and it makes a lot of sense because of the cost effectiveness of ETFs, as well as the role it plays in terms of asset allocation. Do look into the gold ETF. ICICI Pru's gold ETF. The festive season is coming in. they've got enough amount of liquidity on the ETFs. Do have a look at the ICICI Pru Gold ETF as well. I would like to thank Chintanji for being a part of this webinar and sharing his experience and knowledge on ETFs. We had a great session. We learned a lot from this. I would also like to thank Karandeep for helping us coordinate with this session. So thank you so much. Thank you participants for attending the session, and thank you so much for your time.
Thanks a lot, Headley. Thank you, everyone. It was our pleasure. Thank you, and happy Diwali to all the listeners. Thank you.
Thank you so much. Thank you.
Thank you, Chintan. Thank you, Hadley.
Yeah, thank you so much.